welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshil Mehta. Let's welcome our guests on the show today. Joining us today are Sameer Khar of Target Investing, Vinit Bolinchkar of Ventura Securities, and Ritesh Ashar of KIFS TRADECAPITal. Many thanks to all of my guests for joining me. On the show today, we discuss the capital goods sector that may see benefit post the cut in corporate tax. We ask analysts which is the best play in this space other than Larsen and Toubro, because that's more on the construction side. We discuss whether valuations are now a concern for Bajaj Finance. The stock has gained over 55% this year and trading above the 4,000 level. We talk about the hotel stocks which are also buzzing in trade yesterday post the cut in GST rates. We ask analysts whether there are any hotel stocks that are worth investing. And lastly, we ask analysts about one stock that they have recently recommended to their clients. So could be a mid cap, could be a large cap, could be a small cap, could be anything. So those are the themes that we will discuss on the show today. But first is the capital goods space. And yesterday, L&T was up 10%. Most of the other counters, Siemens, ABB, all of them did manage to rally significantly. Have cooled off in trade today. And one of the key reasons was the cut in corporate tax. Now, once corporate tax comes down, there is enough free cash flow, there is enough cash flows which can be, and the deal that the FM said that the new investment could just get 15% tax. So there is a hope of new capacity coming in, and that is why some of these capital good companies did manage to rally. So we'll ask our guests what they feel on it. Vinit, we haven't considered L&T because it's more on the construction side, but pure pay capital goods, is time returning for them? Will this move kick up investment scenario in this country? And if yes, which are the key beneficiaries here?
So this will definitely kick up investment in the country. But if you see the top line, they're all very expensive. If you take ABB, Siemens, they're quite expensive. We would like to go more with the defense plays.
Okay.
So out here we like BDL. It's got a 10,000 crore order book, which is 3x sales. Very, very decent margins, which are upwards of 15%. There's a lot of volatility in the margins, and the government has a strategy to bulk up exports through Make in India. 5,000 crores of exports they want to take to 35,000 crores in 5 years. So I think this is a premier body, and the entire defense system is outlaid around missiles. So this guy is a pioneer player in the missile development program. So I think this stock, which valuations are very cheap, and it's kind of under the radar of everyone. There's no coverage on the stock. And although there has been no growth so far, what the government is looking at is speeding up the development program of the forces, because through simplified procurement. So I think this is a very good value play available out here. Good margins, good return ratios, and with a 3-year order book, I think there is a kind of a moat around the business. So we like this stock a lot.
Just a couple of questions. First of all, the defense play has been going on for a while. What has changed now that defense will get the impetus? And secondly, you said that most of them are cheap. What about companies like Indian companies like BHEL and all? Those are not cheap and those are not expensive. The MNCs were expensive. BHEL is cheap. What's your view on that?
So BHEL, it's not in our area of coverage. Number one is because there is too much of they're largely into power generation, and in that area there is not much happening because the entire focus is on renewables. Okay, so the order flows out there are not there, and is now competitive bidding. So there you do not have any kind of moat.
No guarantee.
Yes. Here what happens is that you have a definite moat. See, if you notice that, just to give you a little bit of historical perspective, the government was very sanguine that we needed 30 days of defense procurement to fight a two-border war. So there it was expedited. So there's a lot of policy procurement planning by the government to ease, and there are two things: our forces are outdated, so you need to really up the ante on that. Second is the entire manner in which warfare is done, is less of army personnel and more of guided trajectories. So that is where BDL gets a lot of business. So they do anti-guided missiles, they do your surface-to-air missiles. So there's a lot of emphasis on that. So I think they're in a very, very good place to do that, and they also got tie-up with DRDO. So DRDO is a very premier body for defense research. So I like this stock a lot.
Okay, what's your sense, Ritesh, in terms of capital goods? Do you think some of these companies that operate in pure play capital goods will be benefited?
See, overall capital good index, if you look at from the BSE perspective along with an benchmark index, it is almost degrown by 2.5% in the 1 year, and almost 12% in 3 years and 20% in 5 years. There are a lot of lack of demand in the capital equipment from the government and the private sector as well. The slow consumption demand is also impacted a lot. So considering that aspect, it was a quite slow growth movement in last 5 years almost. So if you look at a stock specific, KEC International is going to be our strong bet. This particular stock profile is more about the power transmission and distribution, and at the same time they are looking into the smart city and the developments project. They are into the civil also for this matter. So overall, if you consider the international business has almost grown by 12% on year basis, and if you look at the EPS is also growing by 22%, and simultaneously the revenue growth is also growing by 21 to 22% on year basis. So performance wise the stock is fantastic. So I personally feel in capital goods per se, if you wanted to select, KEC International is going to be a strong
What
bet.
about valuations and financials?
Valuation wise is quite decent compared to the peer groups if you compare with an PE and earning per share. So I feel valuation wise is quite fair value compared to the other groups.
Okay, so there is BDL, there's KEC International. Samir, what's your sense on this space? Is there a re-rating possible, and if yes, which are the stocks probably that you think that would fit that space?
So I think given the valuations and especially last 2 days kind of up move, any kind of corporate tax kind of momentum or eventually turning into earnings has been kind of factored in. So if you remove that, I think irrespective of that, there's this company called AIA Engineering.
Yeah.
So it's mainly into clinkers and then cement capacity utilization and other benefits. So they are involved in making clinkers to cement usage, right? So the more cement volume growth comes up, the more AIA benefits out of it, because it's an industrial consumable, right? So and this has been kind of a 30% kind of a capacity increase recently, which has been done, and another 15% is coming online in next 12 months. So I think AIA on a standalone basis, irrespective of whether the recovery comes in or not, has a stability of earnings, and I think now post the capacity expansion after 4 years, the market share gains are to be made, which is right now competing to a China import. So I think over there, and a lot of IP is in the company. So that's why that gives a little bit a higher valuation and kind of a monopoly in the system as well.
They make these grinding balls, right?
Yeah,
And so basically, it's basically catering to the cement sector. Most of the companies in the cement sector have already announced capex. So because of this, do you feel that there will be more capex that will come in the cement sector, and that is why you would play this? Because this is not a pure play capital goods or an engineering company. It's just named engineering, but it's not an engineering.
No, it is engineering, and even if you see the patents which they have filed, that's purely based on the engineering end of it. That's where the mistake goes, that it's more of a consumable, right? But eventually the consumable grinding balls has a lot of metal patents there, and I think globally they are almost on a 60-65% kind of a market share as well. So over there, that beats the markets as well. The market is smaller because they are a consumable. So I think the capacity expansion is one of the plays, but again I'm saying the volume growth within the cement sector is going now at least a 10%, 15%. So if I want to play a higher capacity utilization at cement end, I rather play it through AI engineering rather than going through directly a cement sector.
Okay, that's the view that's coming in on the first question. Counters like Bharat Dynamics, AI engineering, and KEC International are being spoken about. So those are the counters that you need to watch out for. The other interesting stock is Bajaj Finance. It's been extremely volatile from levels of 3,500. It went sub 33,000, and yesterday in trade it hit the 4,000 level. No doubt trading at record highs. Valuation by far one of the most expensive counters on a price to book basis on the financial end of the market. But our valuations now at 3,500, people were already talking about it being overvalued. Now it's at 4,000. What should one do on the counter? Ritesh, your view, is it overvalued? If someone is looking to enter, should they enter? And if someone is holding, should they exit? Or is it time to still hold on to the counter?
See, someone is already having a position, it's better to hold it, or rather book profit and buy again at the lower level. Right now at the current market price, definitely yes, it is an expensive counter. So whenever you are getting at the downgraded level, it is considered to be in buying opportunity. But in this long-term point of view, the company has performed consistently from last 3 years. If you look at the AUM of the company, is almost year-on-year basis growing by 41%, which is fantastic. If you look at asset under management is running at around 1,28,000 crore, which is an decent amount of AUM companies holding it. And simultaneously, if you look at the companies doing a financing in terms of retail, SME and commercial customer, so I think the portfolio is more diversified. It is a micro level financing what company is into. So long-term perspective, the way company is growing AUM and the revenues per se, I think 19% profit margin is also fantastic growth for overall Bajaj Finance. So long term, our target is around 6,000, but definitely at 4,000 level, it is considered to be an expensive. But whenever the opportunity comes to around 3,300 again, it is considered to be in buying opportunity. The target horizon will be 12 months.
Okay, so it's a buy on dips kind of strategy, even though it is overvalued. Samir, your sense on Bajaj Finance? What should one ideally do on this counter?
So I think totally don't exit your old positions, but it's a point where you lighten it out. Let's talk about fundamentals. If you see the quarterly numbers, there was a slowdown on the new customer acquisition and the loan growth given per customer. So there is a kind of a system slowdown on the consumption end, which is through the discretionaries mostly, and then a part of Bajaj Auto also gets kicked into Bajaj Finance. So I think that kind of a slowdown is there, and it'll take at least 6 to 9 months to recover on that. So meanwhile, these kind of a bumps up becomes a better place to lighten down the position. Don't totally exit it, but lighten it down, let the system recover, let the quarterly numbers get better. Because if you see, even the NCD market this year is kind of getting squeezed out. Right now only 30,000 has been raised through NCD as compared to 65,000 same period last year. So I think over there also there's this kind of clog on the funding as well. And even they are going for a QIP sooner than later. So I think these kind of overhangs brings in a little less room for any kind of a discipline.
Will they be able to grow at the same level that they were? Because they are confident about it, but you think on a higher base, the growth probably will taper down over the next few quarters?
See, again, over a long term, I don't feel they'll have an issue, because till the time, even right now, the funding preference is being given to them. So that supports their increase in market share as well from here on, because a lot of players are facing funding problems. So that gives them an edge. But I think in the shorter or medium term, they'll still feel the pressure from a kind of a higher base. And that kind of a growth can really disappoint you in one quarter result.
Okay, that's the view that's coming in. And Ved, what's your sense? What have you told your clients on Bajaj Finance? What should one do?
So it is richly valued, no doubt. But I think there is still upside for about 10% on a DCF basis. So what drives the confidence is the fact that competition is not able to raise monies. Consumer finance may managing the asset quality is very difficult, which they are able to do and they've demonstrated that. So I think the growth is here to stay because they have the funding ability, they are raising equity, and if you are raising equity in this kind of market, shows the confidence of the market and the fact that they will be able to manage this kind of growth. So I think over a decade they can grow above 18 to 19%.
What about competition? Because if generally if you see, will they be able to compete? Because HDFC Bank's subsidiary HDB Financial is going very aggressive. You go to a Chroma, you go to some of the other outlets. It's actually parallel. They are saying Flipkart is giving loans on its own. HDFC Bank, Aditya Puri in a recent interview said he was very aggressive in terms of the scheme. Will that not tend the market share, and then probably valuations will become a concern?
So if you see, HDB has been growing at about 20%, while last quarter and the one before that, Bajaj grew at 40%. So they've upped their growth rates, and they're not present in too many geographies. So I think the more they become a pan-India play, I think the growth will sustain from all those areas. Geographic expansion will support the growth. And the government is doing a lot of things in terms of setting up shamiyanas in 200 districts, where 1,000 people would be there. And the bankers are there who are providing the loan mela sorts. So there the focus is more on affordable housing and doing vehicular loans. And consumer finance is something which PSU banks don't want to do it because they do not have the expertise to collect. So that is where Bajaj Finance is trying to, jump in and play proxy to the consumer finance story. So I think this way you will have deeper penetration geographically. The market is huge and it's absolutely underpenetrated. So if you see the way the electrical usages are going up in hinterland because of the massive scheme of electrification, and you have consumer durable volumes going up. So I think that will sustain Bajaj's growth rate.
Okay, that's the view that's coming in. 75% up move in the last 1 year. Bajaj Finance has been the best performing Nifty stock, at least on a YTD basis. So again, while the other two guests are still positive on Bajaj Finance, indicating that they should be bought on dips, Vineet still believes there's a potential 10% upside on the counter. The next theme we want to discuss is hotels. Now, luckily, at least over the past few quarters, we've had new hotels that are getting listed. Otherwise, there was just an Indian hotels or some of the smaller unknown hotels that you could talk about. But this GST rate cut actually came out and on all three slabs, and most of the hotel stocks rallied. That has not carried forward in today. So has that rallied fizzled out? Is there any hotel stock that someone should accumulate at least for the long term? So Sameer, now we have a lot of hotels that are listed. Earlier you had some which probably like a Leela or a the EIH and all, they've all gone out. What's your sense on the hotel stocks, and if you had to buy, would you buy any of the hotel stocks?
So I think in the hotel sector, you need to be, properly backed by a good kind of a group, because otherwise the leverage goes too high and then you're not able to sustain these kind of average selling per unit. So I think I'll still stick to Indian hotel because they have a good expansion plan in 2022 and now they've got Blackstone JV running up. Secondly, if you see the GST benefit comes to them because they are into that 7.5 category and below that as well in the corporate end. And thirdly, the corporate tax rate cut which has come out. Hotel sector, if you see, is one of the highest tax paying sector. They pay around 38-39%. So that benefit also leaves out a certain cash flow to them. So that increases their cash profit. So I think if their capacity expansion plays as they want to play, so they have an ample of liquidity available for that without over leveraging themselves. And I think over there's this possibility of kind of doubling the valuations from here, at least in the next 3 years or 4 years. But yeah, I'll suggest a SIP mode rather than going all in at a lump sum level.
Okay, what's your sense on the recently listed hotels? There was Chalet, there was Lemon Tree. I don't know if some other hotel also listed, but what's your sense on these newer ones?
But if you see these newer one getting listed, the leverage is so high in the system and the working capital issues are so much that even a 10% in a quarter on a on-season kind of a quarter, if the 10% price cuts are taken, then there becomes a problem.
Okay, just hold on. We have a bite coming in from the RBI Governor Shaktikanta Das, who's addressing the media. Let's hear in.
Definitely in a very competitive position and should be able to attract higher investments. And so far as domestic investors are concerned, I think domestic investors also, they have with a lower tax. Obviously, the domestic investors, the domestic companies, the Indian companies can, they have now more cash left with themselves, so they will be able to undertake more capital expenditure. They can invest more. Some of them can deleverage their liabilities, and which will add strength to their balance sheets. And so therefore, on net, I think it's a very positive measure, and it will have a good impact on the overall economy, and that's it.
सर जैसे यूएस ट्रेड
कंपनियों के पास काफ़ी लिवरेज होगा, नए जॉब्स के लिए 15% जो रेट आया है कॉर्पोरेट टैक्स का, तो ये सब मिला के आने वाले दिनों में किस तरह के जॉब की
नहीं, वो अभी उसके बारे में इतना दूर तक मतलब असेस करके कोई कमेंट देना ठीक नहीं है। अभी तक के लिए ये जो कमेंट है, आई थिंक दिस शुड बी एनफ। थैंक यू।
आज की मीटिंग के बारे में बताइए।
Okay, that was the RBI governor speaking on the tax rate cuts that just came in. Vineet, what's your sense on the hotel space? How should one position themselves? Is it, if someone is looking, let's say, at an investment perspective, is hotels something that you would recommend?
See, it's a over-invest space. So, we are very bullish on the space.
Okay.
There's one particular reason is that room creation, capacity creation for the last 15 years has been outstripping demand. And that is now changed. And there is no one really going in to create that kind of large capacities. So the dynamics have tilted in favor of demand. And we've seen a great, with the Kashmir problem also being settling down. I think tourist arrivals in this country will grow. So if you think of the Mahakumbh Mela or you see the Sardar Sarovar visits that have gone up, I think the exponential demand is going to be created. The cut in the GST is going to stimulate domestic travel. So international as well as domestic travel, and because of the new policies of the government, you're going to have corporate travel come in. So you are going to have your occupancies kick in, your ARPUs grow, and that is really going to contribute to profitability of the sector. But what today I'm talking about is stock is slightly different from the conventional hotels. I'm talking about Apollo Sinduri, which actually does catering and facility management services for the Apollo Hospital Group.
Okay.
So they have hardly scratched the surface of the entire group, and they're also going to be catering to other hospital chains also.
Okay.
And they've been growing at about 14-15% CAGR in revenue last few years. This year they have upped to about 17-18%. So this stock is available at 21 times. ROE is about 17%, and there is a huge growth curve, and the stock is available really cheap.
Okay.
So we think that this stock can do very well going ahead.
And how are the financials? Are they profit making?
Yeah, they're profit making. They're debt free. They've got 10 crores of bottom line, 165 crores of top line. So I think they should do.
And
really
valuation wise, you said 21 times. So
21
compared
times.
to, I don't think
21 times is TTM, and there is no comparable.
No comparable.
Yeah.
Okay. And what about the conventional hotels? Anything that you like in that space, or that's something?
So we'll stick with Indian hotels.
Indian hotels, that's something. Okay, that's the view that's coming in. But just remember, Apollo Sunduri, I think it's a low traded count.
Yeah, it's a small cap.
Yeah, the volumes aren't there. The last time I saw it was some 300 shares that were traded. So that's something that you need to watch out for. Ritesh, what's your sense of hotels? Obviously, there must be some bit of excitement in terms of the GST announcement that came in, but that most of them have corrected now. Are you telling your clients to go ahead and buy any of the hotel stocks?
Indian hotel is which was my strong and the preferred stock in this segment. There are multiple reasons behind it. If you look at overall hotel diversification across the globe, or rather in domestic, it is 151 hotels. Every year they have planned to come up with 15 new hotels on the contractual basis. And if you look at right now, the room occupancy is around overall room is 18,400 rooms. They have consist of 151 hotels. So occupancy ratio is around 60%. But after GST revised rate, and they are into the more having a market share into the domestic market, it is expected to increase by almost by 10%. And due to digital way of booking hotels and the rooms, it is more attractive to the consumer per se due to good offers. So I feel hotel business is going to be a rock in coming future. So Indian hotel is going to be a strong bet in this counter.
Okay, so I think consensus view is Indian hotels, apart from Apollo Sinduri, which is a pseudo play on the hospitality industry. That is something that we spoke about. And finally, over the past 2 days, the markets have seen a bit of revival. I think a lot of traders, a lot of investors have hopes that probably this rally may continue. So it's time to ask our guest whether over the past few days they have recommended any of the stocks to their clients. Vineet, any stock, be large cap, mid cap, small cap?
So we like in the mid cap space, we like R9.
Okay.
The reason being there's a clear shift from the deal has been done. Nippon is clearly in the driver's seat, and what they've particularly done is they've gone to the 100 corporates and the large HNIs who have been withdrawing their funds from the redeeming funds. So there is clearly a backstop, and the overall the AMC business fundamentals are very, very robust for the next 15 to 20 years. And given that kind of environment, I think that AUM growth is given for. We expect them to grow at 13-14% long term. Also, there is, if you compare HDFC AMC and Reliance AMC, they have the same number of employees, but the costing of RNAM is very high. So there is a lot of scope for some cost reduction also to take place. So keeping these things in mind, and Nippon being the most oldest fund in Japan, I think there is a lot of scope for overseas funds also flowing in and domestic business also growing.
Okay, that's the view that's coming in. Ritesh, which stock have you recently recommended?
We'll prefer to go for HDFC Life.
Okay.
If we compare overall peer group of HDFC Life is SBI Life and ICICI Pru. If we'll compare from IPO rate, the stock has almost moved by 70-80% up. But overall, if you look at the performance of the company and the premium they have been collected, it is growing by almost 45%, which is quite decent compared to, you may consider it as a double digit growth. And life insurance is the product, it is now in demand. So there are a lot of opportunity and the scope is left to penetrate the overall population of India. So this product is going to be continue, particularly there if will be bifurcate, there is a term plan, it is going to be growing by almost 50-60% on year basis. The traditional plan has grown down drastically. So I feel the life insurance sector, particularly HDFC Life, who is performing quite better, it is going to be a strong growth territory from here on itself. So HDFC is going to be a strong bet.
Okay, RNAM, HDFC Life, again in the financial space. What have you recommended?
So I think I'm sticking to HDFC Limited.
Okay, so I think again financial seems to be the flavor.
Because even before this kind of event took place, I think HDFC Limited has a lot of scope of growing the market shares in the next couple of years. And then you're able to, pass through this volatility of events or any kind of ground data in bringing the markets down. So I think it's better to do a SIP in a consistent player and better play off this way rather than anything else.
Okay, so that's the view that's coming in. Again, the picks that our guests have indicated again in the financial space. So HDFC was the last one that Sameer spoke about. But with that, we're completely timed out on this edition of Hot Money. Let me thank my guests who've come in today. Thanks, Sameer. Thank you so much, Ritesh. Vineet, thank you so much for coming in today. Ask BQ comes up next. Stay tuned to Bloomberg Quint.